Hello and welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, I'm going to team up with Andrew Cox for a shipper econ update. But first, we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Thursday Carrier Update presented by PowerFleet. I'm Zach Strickland, and today I'm going to break down what we're seeing with the recently released Cass line haul index data, as well as some spot market information. So we're seeing a bit of a divergence in spot market and contract rates. So Cass line haul index is a little bit more representative of the contract market and freight. Now, this is the Cass truckload line haul index, so it is a pure number where it's representing the move of just pure truckload without the fuel, accessorial charges, inside delivery, all that kind of stuff, moving throughout their information, which represents roughly $30 billion worth of spend in the industry. Now, this one's going to be a little bit lower because a lot of that spend involves intermodal, LTL, etc. This is just truckload movement in this information. So you see this blue line right here. This is our Cass truckload line haul index. Now you see up in 2018, this thing is steadily climbing, and now ever since about October of 2018 has started to fall back down. That is because contract movements take roughly 12 months to move. So you have a lot of contract annual bid action happening in 2018 towards the end of the year. These contracts start to get implemented at a higher rate, driven by, if you see this line right here, this orange line, this is the average long haul spot market rate, DAT long haul spot market rate right here. You see that this also was trending higher in 2017, 2018. And then falls off a cliff around October of 2018 and into early 2019, which everybody can see here that 2019 was definitely a muted year compared to 2018. Now, slowly falling behind it, the line haul index here, as again, a lot of shippers, carriers locked in these contract rates at the end of 2018, 2019 at a higher rate. So you see that these contract rates staying elevated until January of this year, where it's one of its biggest drops year over year since 2008, 2009 with the Great Recession. So 6.6% down early part of this year. You can see that contract rates did follow spot to an extent as spot market remained relatively calm. Now, just recently, we're looking at the spot market heating back up. You see a big V right there in terms of spot market activity rate going down and up really rapidly. We had a little bit of a correction coming up, as those, again, contract rates tend to be a little bit more sticky than the spot market, just due to the fact that they are annual cycle bids more often than not. Now, what does that mean for carriers in general? So here's the Cass line haul index. Again, I've got it pulled out a little bit further, and on top of that is the TCA flat or van driver revenue per truck per week. You can see that it follows the contract market quite cleanly. Again, these are small to mid-sized carriers in general, represented in that TCA data, so it's following the contract rates. You can see the driver revenues per week rise as those contract rates rise, and then fall as some of the contract rates fall. Now, I have to say that there is some spot market information in that Cass data, but contracted freight and truckload drives the majority of the volume in that industry. So again, spot market starting to heat back up. It has to stay elevated for a period of time for those contract rates to follow it, and it will come down as those spot market rates start to fall as well. So right now in the country, we're starting to see a little bit more activity in the spot market with tender rejection rates coming up. Let's see where in the country we can kind of focus on today. We've got the weighted rejection index over here. We talked about Dallas yesterday. Let's go into Kansas City, Missouri, out here in the middle of the country, where we have a little bit more activity highlighted in green right there. Kansas City, again, a nice center point of freight. A lot of freight originates in Kansas City, but it has come a little bit more consumer oriented as of late. But tender rejection rates here in the last several days to a few weeks really taken off, all the way up to 12.3%, well over the national average of 7%, just over 7%. So reefer rejection rates 23%, van rejection rates at about 8%. So a lot of reefer activity going on right here, especially if you're a reefer carrier. You can hop into the spot market and find some freight more than likely. So anybody operating out of here today needs to pay attention to the spot market, and that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your shipper update with an econ twist. I'm here with Andrew Cox. Andrew, what are we going over today?
Anthony, today we're going to go over a couple of the data sets that have been released this week that give us insight into the industrial and manufacturing side of the economy. The first one is the overall industrial production. This comes out from the government. This is for the month of May. The other one will be for the month of June. And what we're going to see here overall is that things have stabilized. We don't see incredible growth or even kind of a snapback, but we are seeing things slowing down or stopping the decline, which is a really good sign. So this is overall industrial production for the entire country. Most industries saw gains. They do break this down by industry, and this is the outbound tender volume index for Michigan. If you had been watching Sonar for the last month, you'll see that Michigan has just been pumping volumes ever since they opened their automotive plants back at the beginning of May, and so you saw automotive with the biggest one-month gain of any of the industries this month.
Right, and just as you mentioned, automotive being one of the few industries that did have some significant growth here. And up here we have industrial production year-over-year change for motor vehicle and parts. And just as you mentioned, this is a very similar shape to overall industrial production. We had historical lows last month, and for much of the macroeconomy, we're expecting April to really be the lowest point for this entire duration of the recovery. And so seeing that bump up is encouraging, but you have to keep in mind, I guess, the perspective of the levels and the change. And so I think last month's results for industrial production was actually the lowest on record, and that's over, I think, a 100-year record. And so when we're seeing that drastic decline, to only be up, I think, roughly 1% from a historical low is very telling. It's nice to see that upward movement, but it's still a long way to go.
Yeah, I mean, people need to get, bring their expectations down a little bit. It's going to be a slow, it's gradual climb back up to pre-COVID levels. It may take several quarters till we get back there. There's been a lot of job loss. The job portion of the industrial production was still down 3.5%, so they're still losing jobs in this part of the economy. So yes, it's going to take some serious time to get back. Another index that we can look at to kind of get a general understanding of the industrial production. This is the New York Empire State Index. This basically gauges the industrial production in that region. And again, people that have never seen this index, they may look at that drop in recovery as a V-shaped recovery, that we're back at normal. But this is, of course, a diffusion index. So 0 here would mean steady, stabilizing conditions. And that's what we're back to now, but we're still at a much lower level than we were pre-COVID.
Exactly, just as you mentioned, it's almost signaling that the bleeding has stopped.
Correct.
And I think the future outlook, because this is broken down in different components, has a lot more optimism built into it. But as of now, just as you mentioned, New York really has been one of the slower states to reopen, of course, being the epicenter within the U.S. for COVID-19. So surely going to be a little bit more cautious when they're reopening. So good to see that there is some stabilization, but as you mentioned, going to be a long road of recovery ahead, especially for manufacturing. A lot of industries are going to be changed permanently from this outbreak, I think, especially when we're looking at employment levels. There's going to be some temporary layoffs, but I think the biggest part, some industries are going to have permanent layoffs where people have to be completely shifted altogether.
Yeah, no doubt. We've seen that, I think, in automotive and in airlines. You've seen people, I think people are looking at a slimmer future for these companies. Speaking of future, you're right, the future expectations portion of this index was actually the highest that it's ever been in the last 10 years or so. I think it's at like 58. On the index number, so that's really good. People are expecting 6 months from now to be much better, but again, it's still some tough roads ahead. The government money is running out here at the end of July, so we'll see if there's enough demand to keep those jobs on post-July. It's just going to be, time will tell that.
Excellent. Andrew, thank you so much for that update and joining me here, and thank you so much for tuning in. That's going to do it for the shipper update, and that's also going to take us to the end of this episode of FreightWaves Now, but the content doesn't stop here. You can check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.